Good evening, traders from around the globe. Special greetings to everyone today, tonight. Um, I'm JAD-FX. All right, so let's go straight to the details. Today being 9th of July 2026. Today is Thursday. Yesterday I made a video on a trade I took, and then we are looking forward into certain things. Some persons will say, why was this? Why was that? Why was that? I was actually expecting this correction to the up, which I stated out. That was yesterday. You will see that I put this particular horizontal line here and this particular horizontal line here. There is something that each of them significantly represents. When I look at the market from a perspective, there is something I do. I study market. Okay, let me just go straight to something before we go straight to that. Let's have a brief study on the candlestick. Yes, let's have a brief study on this before we move further to what I have to discuss this very night. This is a daily candle. If you can see properly from this side. Okay, let me just bring this drawing to this side. This is a daily candle, and if you look, this overbody candle represent the daily, and this other one to represent the daily candle. That's this particular candle is the sell candle, but this is the buy candle. In your own part, it might be a buy. I don't know how you annotate your own charts or something, but to me, this particular one, not that one, sorry, this particular candle here is my buy candle, and then this particular one right here is my sell candle. This one is the buy, while this one is the sell candle, and I tend to this is the buy, and then this is sell. That's what I use for my buy and sell. So let's go straight to the point. Now, one of the things I come to understand about, let me just share these tips. It's part of when I come up and start talking about trading. I'll start sharing about my ideas and the method I learned from ICT, and I learned a bit from I've went extensively, and I've learned from ICT, and I also learned it's not physical class though, but I saw the most of his material. I followed every of his mentorship, and I also followed them some ICM SMC guys, which I was able to deduce a model from compressing harnessing the both of the ICT and SMC. I was able to come up with a model that helped to strengthen and show me a perspective to the market. So today I would just like to share it's a very, 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 but I call it my own kind of silver bullet, because it is very, very precious and very, 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 very effective if you understand how to apply it. This is the daily market. So a lot of persons run their daily buyers and all that, and all that is very good. First of all, I told you yesterday, that was on the 8th, that the first thing you understand is not to trade structure, is to understand the narrative behind the structure before you begin to even talk about building structures, because there are certain structures that are deceptive. Yes, they can be deceptive. They will build themselves, and at the end of the day, they are all liquidities. Do you understand? So let's go straight to the details. Every market, let's use a normal market scenario. Every market has a price. Yes, ICT spoke about time and price, the theory of time and price. Let me confirm to you that I am actually a student of ICT, and also a student of the SMC. ICT, in fact, let me not give a preach to that, but let me just go straight to what I want to say. Every market, there are two there are two major participants that constitute the market. There are two forces that constitute the market. There are two market forces. Let me use that word. We have the demand forces, and we have the supply forces. The demand forces is the criteria of the buyers. You understand the criteria of the buyers? Why the supply axis has to do with the criteria of the sellers. So you will agree with me that a market is said to be complete when there is both buyers and sellers. Because if there is sellers, who are those who are to buy? If people are not there to buy, then you who is selling will eat what you have to what you brought. And so to also to buyers, you can't come to a market where you just see only buyers. Then who will sell to them? So you see, when you are having only one particular personalities in the market is said to be at the state of imbalance. That is what we call inequilibrium. The market is at the state of imbalance, unless when there is an agreement between when there is a buyers and sellers in the market, then we begin to have what we call the balance, the equilibrium. The equilibrium normally happens where the institutions are agreeing, where the institutions are taking order at a specific price. They are using a particular price to make an agreement. There is a collective agreement in around one particular market price. Do you understand? Both the orders. That means it is a point where the buyers and sellers come in agreement in a particular price and at a particular quantity. Do you understand? So at that bridge point, we call it equilibrium. They are all in agreement. In the forex term, we look at those points to be a consolidation period, because there is no excess and there is no deficit. So let me just leave throw off those ones out the window and let's go straight to what we have today. Looking forward, every time I look at my daily market, hmm, I want to first of all look at the daily close, and then I want to also look at the daily open. Sorry, I'm going to be marking out these kind of things. I want to look at the daily close, and also I want to look at the daily open from here. I want to look at the daily open from here. Some of us are already familiar with this, and I want to look at the daily close. Let me do something. Sorry. Let me bring this horizontal line here. Every time I come to the chart, I want to first of all spot the point where the institutions close the market for the day, where they did their closing price. These other ones, the week, are just an extension. You understand? A rejection point, that's not the point of where the market closed. Also, I want to understand the basis where the institutions stacked their orders. That point for me is a reference point. You see these 2 points? They are both price reference point. We all know that the green candle opens, the buy candle opens at the bottom, while the green candle opens, the sell candle opens at the top here. Then it closes, the buy candle closes at the top, while this top here, the body top here, while the sell candle closes at the bottom. So this particular point we are seeing here is called the weak rejection area. That's the price pressure, the weak rejection area. That particular week that went up. So that's not what we have to say today. But let me just go straight. Once I've finished, let me take out this. We already have the clue. Some of us have the clue to this. There's something I just want to pick out. That's why I just made all this. Let me take. We already know that this is a daily candle. So just watch. When the market, every market has a particular tagged price. For instance, if I go and buy a commodity or a goods today, let me say a pig milk today, and then I want to sell that pig milk. I bought that pig milk, let me say today, or let me say last week. I bought it last week for $5. Now pig milk $5 as of last week. That was the benchmark price, as in that's the price for last week. So I will look into if maybe somebody within that last week, somebody probably want to buy, and then he doesn't have an idea of the price of the market. I can tell the person, oh, then this week this person want to buy that same milk at that level. I will now make reference to the price. If the person asks me, I will now make reference, or should in case me myself, or maybe I'm having a visitor, or me myself, I want to buy. I will now make reference to previous day price. That okay, I bought it $5 last week. Maybe price has make an extension. I will use the closing price. That last week price will be my closing price for my reference. I will say that was the conclusion price, but that's my reference price. I'm going to use that price to forecast and know whether I'm going to add, make an addition, there's going to be a surplus or there's going to be a deficit. I'm striking between that consumer budget line. And then when I go to the market and I might now say, okay, let me just add up $5. Maybe the market has dropped below that price or went up. Do you understand? Let's take for instance, yes, maybe it has dropped. So if I go there and the market has dropped from maybe from that $5 to $3 pig milk, then $2 is my consumer, that's my surplus budget. Now my surplus this thing, that is a surplus budget for me. But if the market should increase by $2, that's $7 now per this thing. I'm going to add up. So what I'm doing is I will add up money first. The way I'm trying to do it now is a kind of confusing. I will add up money to the $5 if I'm going to the market because I know that price fluctuates. Yes, price is not static. It's not fixed. It fluctuates. So I might add $2. So when I go to the market this week, comparing last week price with this week, when I now go to the market this week, I'm going to add up money should in case the price of that particular commodity increased. So when the price of that commodity did not increase, maybe it reduced by $2, then I'm having a consumer surplus. But if it increases, then I'm going to know that okay, I'm on the safer side because I've already made a provision for that increase. So it's not going to affect me that much. So this is why we try to adjust ourselves to market condition. We tend to be flexible around the market because at any time there might be some kind of an increment to either favor the consumers. What I'm saying? The market opened or closed. The sell market, this particular price. Let me drag this thing down a bit or up. Then let me shrink this thing so that we can see it. That's the red bar. I bring this thing out. Okay, come out. Let me show you something. This particular candle opened right up here, opened right up from this place, and then it did so down. It came down to this point. It went even down much, but the place where institutions closed the price was here. Are you seeing that? The place where the institution closed price was here, was there. Are you seeing it? Then the next price opened at this point, at that particular point, that same exact point. And what happened? It skyrocketed up here and did closed around this junction here. And then that was where the institution closed their buys for that day, ignoring the week. Let's do away with the week now. So this is where I want us to focus on so that we can get the details to these things. If the market opens here and closes there, that becomes my basis. When the market opens and closes there for the sell, opens there and came down and closed at this vertical line here, that becomes my basis. I'm looking at that particular sell, and I'm also looking at that particular the opening price and the closing price. That's where I'm much interested in. Do you understand? This is the daily opening price and the closing price. It's also a daily opening price and the closing price. How? This sell opened up here and it opened up here and closed down here. Are you getting it? Then the buy still open at that same 378 this place. It opened at this same place. Both the sell closed at that same price. The buy opened at that same price, and then rose and closed at 3916.98. It closed at that same price, but it penetrated into where the market opened before, and penetrated into there and closed in that same exact point. That's just the framework now. When this market like this occurs for me and give me this week and come back here, I will tend to look at the zone where the market is making that reactions from and making that kind of this thing from, because I know that based on this, the market will want to make reference to prices. You understand? The market will want to make reference to previous day price. Very important. The market will always want to make reference to previous day price. Now let's go to the chart. Maybe this one may not really, we may not get the details here. I think subsequently, if I start teaching, I will tend to do as much as possible to simplify this thing, because the market works with time and price. Yes, it works with time and price. If I was supposed to sell this trade, I was looking, but I can't sell it this night. I can't sell it this night. Let me just leave it. I can't sell it this night because there are some of the things I'm looking out for. I can't sell it this night. I'm still looking at this target, but I can't sell it this night. I have to look at the sheet tomorrow. From tomorrow position, I will discover, because I'm having some kind of a additional liquidity around this level, somewhere around this level. So there's an imbalance around that level, something that did not go away. So I'm still watching it. Let's just go straight. Let me go straight to the daily candle so that I will show you what I was trying to take. I'm not going to the weekly, not going too far, so that you know what I marked out in this point. I was telling on 8, I was telling us something regarding this, but I did not use my vertical line. Look at that, was the same thing this Tuesday candle did. Look at this Tuesday candle. Look at this Wednesday candle. Let's just go down. So let me always spend much of our time. When I saw that the market was going down and made a rejection from me, I closed my first trade and left the other one at break even. And the market hit me on break even, and that was not really a bad thing, but at least it's something sizable. I locked my profit and everything went well. At least still on top of the game. But what interested me was, are you looking at the price? Are you looking at it? This was an opening price level. This was an opening price level here. This was a closed price level here, and the price, another market now open, another candle now open. It opened at the same price, 4031.14. The same price. When it opened at that same price, then it skyrocketed up. I like when I see this kind of clean bottom without any this thing. When I see this kind of clean bottom without any this thing, without any wick, I know that institutions will want to make reference to that point very well and give them a very nice wick. Institution will want to there is probability that level might. You can go to your chart and do your research. You understand what I'm saying? But first thing first, let's move. So I like to see that clean low like that. Look at, even to this point, I still like this kind of formation. There are tactics to these things, but when I start teaching, I'll start upgrading that. I just want to show you why I was almost tempting to take a buy, but I left that trade. I don't want to take it because it did not meet up to my criteria, but other people entered. But no, I did not enter. So I've marked out this daily. This is another price level here. I seen it. That's the price level now, and this market made a rejection from there. And let me not even go into much of that, but this was a level that I was looking towards because that was very clean. And the market, when I saw that the market came there, I made a rejection. I made a close. I wait for break even. Then I now look at the position of the trade around that market. This one have already been tapped has already been tapped. This vertical line has already been tapped on Tuesday. This particular one up here has been tapped by Tuesday candle. So I know that has been invalidated. I don't need to consider it. If anything is going there, then that means the market is going to continue pushing up. So when I saw this particular one tapped, I said, no, this thing is something significant. Let me watch what is going to happen. Then I went to 1 hour. Mhm. Because 1 hour is one of my base system. I looked at, I'm not looking at the left, though. I looked at the reaction on that particular price, reference price point. When I look at the reactions, I said, wow, that's great. This is a strategy on its own. I said, wow, that's great. Then I mapped out the levels. I spotted the liquidity and the FVG and all that. I said, wow. But it did not meet up to my requirement because I would want to see a 50% into this level, but it did not enter. So, and also that the liquidity was not really positioned in the way that I will enter. Other people might get in quick, get in and all of that, but I was not satisfied. Then I just say, okay, probably it might run up, it might run up to this block because it did not mitigate with this block. I just mapped it out and left it there. And exactly that same block there, that was where the market came to. I hope I'm not just speaking English. Look at this particular block here. That green block inside here. That's where the market came to. That particular green block there. This particular green block inside there. That was where the market came to. And this particular green block. That's where the market came to and mitigated it. When it mitigated it, it started going down again. So I was supposed to take a buy, but I can't take that buy because the market did not end using my 50%. And then there were some of my criteria that were not met. So I just left the trade. I knew that let me just leave this one to go. I allow it to go. So this was the reason why I got out in break even. So the market was still intact. If I see some kind of, I want to see some level of formation, then I know that I'm going to penetrate this trade very deep. When I see some kind of formation, I know that this trade, we are going to milk it. We're going to continue selling. But for now, this is just what I have to say. So it was this reaction of this daily reference prices that brought about this buy. And the market was seeking for more liquidity before it can go down. This was an insufficient move. This particular sell candle that came down like this was showing an insufficiency. And I told you earlier that you cannot be in a scenario where you just have only sellers in the market. There must be a combination of buyers and sellers. So there must be a correction point and an impulse. Even if the sellers are much, but there must be some point of buyers in the market. You understand? So that's why the market has to give us some buy and take out some levels here. And going to the system, this particular level here, the reason why I would even consider this level, the market is going to come up to this level more here, was because this level was also somehow a liquidity level because it's sitting around an Asian zone. You see this level? It's sitting around an Asian zone. So that was why I was very skeptical over that price level. And that's why the market, I was not saying that, okay, let me see how the market will react on this block. As I marked that block and I see this is a liquidity point, let me see that block. Since the market did not stop at this level, it broke this level, it broke this structure and broke this out, it hit this level and went up. I said, okay, let me watch and see how it's going to be till we got to this block. So guys, this is just what I have to say. So if the market give me a structure tomorrow, I'm going to short it down. But for now, this is what we have here.